Welcome back to the channel. I'm Foreman, and today we have got an emergency stock market update. This usually is my UK stocks that I'm buying now, so I will be talking about that and commentary on brands like Boohoo, ASOS, Associated British Foods, the parent company of Primark, Team 17, Ashtead Group and Darktrace. However, I'm going to get to them a little bit later on, as I feel that this is necessary to talk about the current market movements, as obviously lately they have been quite savage. Now, I think it's very, very vital not to let emotions overrun you at the moment. If we take a look at my portfolio, for example, a lot of people right now would be very stressed. They wouldn't be able to sleep at night. They may even be like absolutely destroyed. Some people obviously are able to maintain this skill or able to be a robot and therefore not do anything about it. But obviously there is a lot of fear and panic and uncertainty in the markets at the moment. There is one certainty in this though, is that the markets are always going to have an uncertainty. There is never a clear path forward and exactly why we're going to grow, because in this time and age, media sensationalism and the way they get clicks is through negativity. They're not going to put positive news out there, therefore we're drawn to the next piece of negativity. What happened to the pandemic? Suddenly people would stop talking about that and moved on to other matters going on in Europe. This is going on all the times. When you know that the markets are cyclical over time, then this really shouldn't be a concern overall, and I think you should really drain out the macroeconomic factors. For instance, I've actually muted words to do with Russia or Ukraine. Quite frankly, if I wanted to look at that kind of media, I would turn on a TV, which I've not done in many, many years. I feel that it's not my place to really keep on top of this. Yes, it sucks for either side, but that's not relevant to the channel or to my own personal life. You might go, well, that's really selfish. How dare you? Quite frankly, if you're unhappy with that, unsubscribe. You don't need to be here if you don't want to be. I'm not after negativity, excluding that voice crack on the channel. Regardless, in the last week, the markets have been smashed. Not as much as my portfolio, but the FTSE 100 is down 6.32%. The FTSE 250 is down 8.03%. The American markets are holding up quite well, interestingly, at least so far as of 10 minutes past 5 on the Friday. This is saying that the S&P 500 is down 1.74% and the Nasdaq 100 is down 3.17%. Obviously, my portfolio has significantly underperformed yet again, and I don't know if I've actually adjusted the stats on this, so my weekly performance here may not be correct, so keep that in mind. But let's assume for this situation that it is, because my total portfolio value, as you can see on the screen, is at £14,500, so therefore it's very likely that it is a correct amount, and I have dropped by 12.48%. Now, in the markets, everything is falling at the moment, but you may be going, a lot of people are telling me, well, you were down 50% in a bull market. I don't respect people that don't make money during a bull market. Well, if you look at the high growth stocks, the ones that had higher price to earnings multiples, they have been absolutely savaged in the last year. And that's not exclusive to UK stocks. For instance, you could look at some of the American stocks and you would see the same thing. PLTR, Roblox, you could just look at ARK Invest portfolio, for instance, all of them down from their all-time highs quite significantly, and that even look at the likes of PayPal, for instance. This is perfectly natural. Stocks had expanded 3 to 4 times during the last year or 2020, which was phenomenal and abnormal. Therefore, it is natural in the markets for these valuations to contract. As now sentiment takes over, there's a lot more fear, uncertainty and doubt in the markets. Therefore, it's being priced down. We're also seeing a tightening of liquidity. We are seeing the Bank of England and the Federal Reserve reducing or tapering their bond buying programs, and in the UK the Bank of England is rising interest rates. Therefore, interest rates look a little bit more valuable, stocks look less valuable. People can now get a safe return on their money of about 0.5%. Bonds are obviously going to be above that by some level unless they are government bonds, and obviously people are slowly moving down the risk asset ladder. This is natural, and therefore the more riskier stocks seen as the growth stocks, especially the ones pre-earnings, are obviously going to get beaten. Even ones pre-revenue like Eurasia Mining, EUA, has also been hammered, although I'm not sure if there is a separate media article on that is calling for that indeed. Now, in the last month, in the last few days, I've deposited £1,000. I've already used a majority of my cash position because I got a dividend as well from Games Workshop last week of about 50 quid. I've already used a lot of this money, and usually I'm quite patient, but right now Boohoo stock is dropping down to 70 pence a share, and I feel it is vital for myself to be lowering my average. It's not sunk cost fallacy. It's not like I'm afraid of admitting these losses. Right now, I could accept and walk away that a majority of my portfolio is down, and I could walk away with a crystallized loss of £15,800. That does not bother me mentally or physically. It only bothered me when I didn't understand what I invested in. Now I'm a lot more comfortable. I understand why Boohoo will recover, and I understand the fundamental business that's below it, and why actually I think the markets are pricing it on a ridiculous valuation as if they're going to stay like this forever, when in reality it's going to be 2 or 3 years and they'll be fine. Again, you may go, well, how's that possible? How can you be down 52%? I feel sorry for you. Don't feel sorry for me. Why should you? There shouldn't be that much emotion in investing. Sure, we're all human. We all do have emotions, and therefore it's a very hard factor to control. But there's no point having negative sentiment if stocks are down and great sentiment if stocks are up. Ultimately, I try to reverse that. And a great comment, which I haven't got to pull up on screen, was by Jack Owens. And he mentioned that if the average investor has subpar returns, then one must be contrarian to the general consensus of the average investor to therefore outperform the markets. And I think that is a very, very strong saying. Right now, there are so many people piquing fear, the negative sentiment on, for instance, my channel about Boohoo. Just because the shares are down, people are panicking. And this is why it's an emergency stock market update. Because right now, people are panicking when in reality, I feel that they should be doing the opposite. This is the time to be greedy, as Warren Buffett says. Be fearful when others are greedy, and greedy when others are fearful. If the market's being down 6 to 8%, the UK isn't fearful, I don't know what is. And quite frankly, this is an opportunity. Yes, right now you could be looking at me and down, well, I'm down over half on my portfolio. This isn't good. I'm never going to make this money back. It's going to take so many years to get my money back. Be calm. At least in my situation, and I've said this many a times before, I'm young, I'm 22 years old. I know that ahead of me I have got a career. I know that at the moment I am down by more than my annual salary this time last year. But I know now that I'm able to grow my salary at a fast rate, providing on how hard I work, and therefore this amount of money is inconsequential to my overall growth in the future. Yes, it may take many years for these shares to recover, but how many years is it going to make as I'm increasing my income? Because this amount of money becomes less meaningful. Excuse me, a really dry throat. I suppose you could say it's a different story. If this was 10 times as much and I had deposited £300,000 and then it dropped by £150,000, if I'm not earning that level of money in a year, then obviously it's going to be a lot more of a concern. But then again, you need to look at it from the mindset of, if I was in that situation where I had a portfolio of over 6 figures, then I'm not going to have a high exposure into 2 stocks. It's all about money management and risk management. Don't get me wrong, I'm very much an experienced investor. Before you start going, is he a professional or something? No, I've never claimed otherwise. But I'm only stating my own opinion on what I'm doing in the markets. As I say, it's about money and risk management. As equity or as your wealth scales up, therefore I feel diversification is informed from systematic risk. You can have a handful of companies, in my opinion. I will have a handful of companies despite what you believe. Again, it's my own opinion. And I'm going to do that, and I will hold a small handful of companies going forward. At the moment, I only hold 2 companies in my main portfolio. Once we come out of this and recover, I'm hoping my portfolio will be about £40,000-50,000, at which point I'll be looking to open a third position, one that isn't as high growth, one with plenty of cash flow, one that gives me a little bit more diversification, such as Dunelm Group. I think that would be a fitting example in the portfolio. And then as wealth scales up, then you can add, or I will add, to a few more holdings. But at the end of the day, I'm not going to hold more than 5 to 10. 10 is already an extreme amount for me because you already significantly lower your returns, but it really depends on your level of wealth, as I've said before. At the moment, I have a very low level of wealth, therefore I'm looking for higher risk to reward ratios, since, as I say, if I lose this money, I can make it back. But if I had a high level of wealth, we're talking 7-8 figures, and it may be a lot more difficult to reach that level of wealth again, then you would look to diversify so that the risk is there. Obviously your compound interest will be working for you, but therefore you want to avoid the systematic risk that one of your companies go bust. If Games Workshop goes bust, boom, that's 36 of my portfolio gone. Like that. If Boohoo goes bust, that's 61.4% of my portfolio gone like that. However, I've done the research on these companies and I know that they have got very good balance sheets. They've got plenty of cash and no debt in the case of Games Workshop, or £50 million using their overdraft facility with Boohoo. These companies are positive in earnings and cash flow, and yes, Boohoo may struggle for the next year or 2 and it may be razor thin margins, but they're profitable. They're strong companies, they've got good competitive advantages over their industry, and they're going to be around in the future. So whilst the negative sentiment is very high at the moment, I implore you, if you can't handle the volatility in the markets, take some time off. Stop looking at the prices, set some limit buys in, and walk away, because it's not going to help you looking at the share price every 5 minutes going, oh no, Boohoo's down another 2 pence. Oh no, it's down 4 pence now. Oh no, it's down 10%. Like, you don't gain anything from that. And actually, to those of you that don't get emotional to this but still watch share prices, what value do you really gain? Unless you're doing it there in the background as a little distraction, something just to amuse you whilst you're bored working from home or something, I don't see the value whatsoever. So let's jump into the core aspect of the portfolio. And I've got the wrong thing on here. Let's make sure that's fixed. Here we are. So we've got Ashtead Group. Now this is just a notice of results. They're going to be announcing their results on the 8th of March. This is a former holding of mine that I sold at around about £56 per share. Now though, shares are looking at £46, and this is just showing that it isn't just some of the stocks I hold, such as Boohoo. This isn't a bull market anymore. This is very much correction level bear market territory. They peaked at about £65 mid-November, maybe till the end of November, and then it's been falling ever since. Their year-to-date return is minus 22.7%. Once more, we've got Team 17, another former holding of mine, which I sold at a very small loss, at roughly the high end of £7. They're going to release their results on the 30th of March. But their share price has absolutely tanked in the last few weeks, for instance, from actually the last half of the month, where they were trading at around about £7.30, although they did slightly dilute shares, do keep that in mind, to fund an acquisition, and they weren't very aggressive with acquisitions, keep that in mind as well, to now all the way down to £4.80. That is an extremely low drop, and obviously the year-to-date return is 39.74% of a drop. That is negative territory. Now, there have been some updates on the whole Russia-Ukraine situation, notably from Boohoo and obviously a few fashion companies. Now, I wanted to note here, because there is a lot of fear priced into the markets, that ultimately Boohoo isn't that involved. Yes, they say the one-liner sentence, as each company have said, they're deeply concerned, all of this. At the end of the day, the thing I'm looking at here is financials. If you want politics, go to a different channel. Point is, it totals less than 0.1% of their group revenue. They suspended sales to Russia, and they don't have any trade in Ukraine. Therefore, obviously, it's not going to impact them very much. When you compare this to what some people would consider one of their closer competitors, but only because they're public and in the UK, like ASOS. ASOS has mentioned that actually suspending sales into Russia means, and Ukraine, represents 4% of their group revenue and contributed to approximately £20 million of the group's profits, which means they're going to be hit a lot harder than the likes of Boohoo. A lot of people telling me, oh, competition's rising, Boohoo's not going to do well, they're going to lose to Shein, they're going to lose to all of this and that. They're not at all. Boohoo has an extreme market dominance. I think it's about 5% market share in the UK, and that's going to continue growing. And the results, I believe, are on, I think it says on the statement about Russia, are on the 10th of March. Yes, obviously you're going to have some doubts. Even I have some doubts about Boohoo. What if I'm wrong? What if perhaps their results are worse? And that's just ultimately human nature. However, from the research I've done and the more logical aspect of myself, I know that this is a very, very well-run company, despite obviously popular belief, due to their obviously allegations of poor governance, which I do believe they have had some poor governance in the past, but they know how to grow a business. This business has grown their revenue phenomenally in the last 5 years, and it will likely continue to do so once the short-term problems go away. We're talking about supply chain disruption, inflation, which is the causation of this supply chain disruption, meaning inbound shipping, outbound shipping, and outbound flights, freight, is it? This is going to cost a lot more, eating into their margins. And due to the delays, this means that they're not able to deliver their clothing as quickly. They only do one-day delivery in the UK, meaning that obviously when they're doing their deliveries in the UK, 1 day, perfect, fast fashion outcompetes Shein, because Shein take 2 to 3 weeks to deliver from China. Yes, they'll have higher margins overall, but then they've got to undercut the competitors to have lower prices in the case of Shein so that they can claw up market share. But if people go, well, Boohoo's going to deliver me a dress in the next day, and I'm going out on Friday, then screw it. Yeah, I'm going to buy a dress right now. Why wouldn't you? Why would you wait 2 weeks if you want to buy this cool dress right now and impress your friends? Shein is not as big as a threat as some people think. And people are saying as if it's the first time competition has ever existed. Listen to yourselves. It's quite ridiculous. Yes, obviously Shein can be a threat. If they set up distribution centres and also production facilities or suppliers in the UK, then yes, they will likely outcompete Boohoo. But it's very unlikely that they're going to do this, seeing as they make a majority of their margins through manufacturing this in China and therefore shipping it over the course of 2 to 3 weeks. And as we see, is that what airline is? I'm not sure, I can't remember. But as we see airlines or their, business airlines, obviously, where they're transporting cargo, once we see those prices decline, this is a promising sign overall and means that Boohoo can be very, very effective. And obviously they're able to deliver fast to places like the US and Europe. Obviously they're setting up that distribution center in the US by 2023. So obviously if they can fast track this in any way, they're going to be very much stronger position as well. Okay, and there was also quite a substantial notification of major holdings by Norway's central bank. Right, they bought 3% initially in like December. Shares have dropped like 40 odd % at least since then, so they bought a little bit more, and now today they have bought a huge amount more. Initially their position size when I last commentated on it was 4.26%. Their position size now is 11.74%, a very high figure which would make them Boohoo's second largest shareholder. However, they also have financial instruments, which is shares on loan, which would mean that they are currently, I'm guessing, on a form of margin. I'm not entirely sure here, but what it does say is that they do have a significantly higher amount of voting rights in total. So it's interesting to see how this one plays out. It definitely seems that at the very minimal or worst case situation that their position size is 5.87%, still a substantial upgrade from the time before. Again, this is going down to my limited knowledge perhaps on analysing these types of statements and RNS, so I'm not entirely sure here, but either way that is a very bullish sign and could be a promising thing to come for in the future for Boohoo. Now, there's also the pre-close trading update, for Associated British Foods. They've said for the half year they expect sales and adjusted operating profit for the group to be strongly ahead of last year. Well, I would hope so, as that would be obviously, but they're also saying sales and adjusted operating profit to be ahead of the pre-COVID levels achieved in the half year of February 2020. Primark sales for the first half are expected to be well over 60% ahead of last year. Again, I want to see tables. I don't want to see all of this text. It's so goddamn annoying. You've got all of this text here. You've got to read it. It's a tiny font. I think I'm actually zoomed in at 100% as well. Like, come on. So I want to see statements here. Cash flow, they are saying that is being much improved on the same period versus last year. Store closures resulted in an estimated cash flow of £650 million. Also benefited from the autumn-winter inventory brought forward from the last year. Net cash before lease liabilities is expected to be £1.5 billion at the half year compared to £705 million in the last year. Their revenue in the grocery half of things is 2% ahead of last year, and their sugar trade is expected to be 20% ahead of last year, driven by higher domestic volumes in two of these names, I don't know what they are, and in higher sugar and bioethanol prices. Interesting stuff indeed. And in the last 2 years, they've opened 27 new stores for their retail, increasing their retail selling space by 8%, although total sales for Primark are expected to be 4% lower than pre-COVID levels in the same period 2 years ago. So Primark is obviously carrying on as usual. It's not going to go anywhere, that's for sure. But is it going to go far? That's really the question, and they are very much limited by being high street only offering. Now, you would have got a glimpse of this earlier. This is my Patreon. I've only got 4 of the tiers remaining left. It's going to be my early access one. I thought at first you price it at a low price, it's going to get more demand. Maybe not, but you get live access to my portfolio, the spreadsheet that you actually see at the start of the video, and you can see all of my trades, such as how many shares of Boohoo I've bought. As I said, I bought in the last week or so about £700 worth of Boohoo shares, significantly increasing my position from the previous week. So if you're interested in that, click the link in the description down below and join my Patreon. on. There is also half-year results for Darktrace. Now, Darktrace are a cybersecurity firm, and they've had some phenomenal results. They've seen their revenue grow by 52.3% over this time last period. They have seen their EBITDA improve by 144.2%. When we look at their operating performance, their constant currency annualized return rate for obviously this is 45.5%. And when we look at their number of customers at December 31st, it is increased by 39.6%. Some very, very strong figures, and obviously there's a lot of detail down here that you could look at, for instance, which I'm not going to go into, mainly because I don't have that much of an interest in the company. It's just not what I'm interested in. But we can see here on the financial review that their cash and cash equivalents is very similar to obviously this time last month, where actually they have about $366 million in cash compared to $342 million last year. Although the deferred revenue is increasing, the net assets is also increasing as well, which is a good sign indeed, and their cash flow before financing activities has increased by 158.8%. There is a little bit more here, and actually I believe if we look at their gross profit, I think they may have turned a profit here. Let's have a look. Okay, net profit. Yes, so actually I believe the company is marginally profitable at the moment, at least in this half, because they had a net loss this time last year of 48 million, I believe. It doesn't, maybe, yeah, 48 million, and now this year they've got a net profit of 5.9 million. So that's promising as well. This is an unprofitable company at first, but it is suggesting that they can grow, and if they can keep growing at these fast figures, then these shares might do well in the future. So they've had some very strong results, and one to be watching, that's for sure. We've also got the London Stock Exchange Group, which have had their results for the year ending 2021. They've said that they're obviously successful first year following the acquisition of Refinitiv, leading them as a global financial market infrastructure and data business. Down here, their continuing operations, they've mentioned that their data and analytics has grown by 5.3% at a constant currency basis. They have seen their capital markets grow by 12.5%, and those are really the two main streams of trade that they have present. Obviously, their other has grown by 21.5%. Excuse my voice is going again. But their gross profit, for instance, has increased by 6.3%. So not bad, but not amazing. So if we go down here to their adjusted profit before tax, which has increased by 26.8%, or their adjusted profit for the year, which is up by 44.6%. So some very strong signs indeed. And for instance, their continued adjusted basic earnings per share is now 286.7 pence, up 46.5 pence. So they've had some cracking results as well. Obviously, there's quite a bit of news in the markets at the moment. As I say, there's a lot of negativity in the markets. As I say, I find it very easy to drain out these things, ignore them, focus elsewhere. At the moment, you might say, well, now is the time to be building cash. Well, I disagree. Shares are falling. This is a time to consistently deposit money into the markets and really build up these positions, because go ahead 3 to 4 years, I think we're going to have some strong returns from this point onwards. And I think that is really what we want to be looking for as long-term investors. And truly here, if we do want to outperform the markets, then I feel that we have got to differ from the crowd. So whilst a lot of you have negativity, bad sentiment, you don't agree with my holdings, which I always encourage, obviously, providing there's points to back up what you mention, then I don't feel that it's a time to really be fearful. I think it's a time to make sure, obviously, you've got an emergency fund in place. Definitely evaluate your job security. Do you think you're going to be made redundant for any reason? Otherwise, you might need to draw down upon your investments without an emergency fund. And it's really a game of placing yourself well enough so that no matter what happens in the markets, you're in a secure position. And that is exactly how I am. Whereas some of you watching this may have financial obligations, such as mortgages. You may have 2 kids to feed and a wife that goes shopping all the time. I don't know, it's just a random example, for instance, and therefore you have a lot of needs to meet with your financial obligations. Whereas myself, I have very, very limited rent payments as I live with my parents. I don't have many subscriptions or reoccurring bills. Life is quite easy for myself, as that's a very fortunate thing to be in. I have this opportunity to obviously live with my parents, and therefore I can make the most of it by investing as much as I can, really absorbing as much information as possible. So as I say, it's really about patience in this market, and as said many times before, is a transfer of wealth from the impatient to the patient, and that really does sum up the stock market. If you'd like to see my free UK stocks to buy in March 2020, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.